Hey everyone, and welcome back to the deep dive. Today we're going to be looking at smaller companies and how they raise money in the stock market. It's kind of like a whole different world out there.
Oh, absolutely. Yeah,
Mm.
it's not the same ball game as when you have those giant companies, the big ones tapping into Wall Street.
Yeah, exactly. And today we're going to zero in on something called the baby shelf rule. Have you heard of this? It's
Yeah.
kind of like imagine a company having this shelf stocked with shares. They can just kind of sell little by little, instead of having to do like a massive offering all at once. It's like their snack shelf at the SEC.
Yeah, a snack shelf at the SEC. I like that. Yeah, and it's really, it's designed for these, smaller, more agile companies, the
Yeah.
ones that, maybe have a public float under $75 million. They have huge growth potential, but they just need a little extra help along the way.
Yeah, they need some snacks. Okay, so we've got the basic picture, but before we get into all the details, the ins and outs, can you give us like the official lowdown? What is the baby shelf rule, officially? And where does it kind of fit into like the whole regulatory landscape?
Sure. So officially, you can actually find this in Form S3 Instruction IB6. I bet some of our listeners are going to go look that up right
That's
now.
some real teeners are going to do it.
Yeah. But basically what it does is it allows companies to pre-register, a certain amount of shares with the SEC,
Yeah.
and then they can over time, sell portions of these shares without having to go through that whole, the registration process each and every single time. So it's all about, making it easier for these smaller companies to get the money they need.
So it's like a fast track, but with like some, safeguards in place. Like
Yep.
I'm guessing the SEC isn't just letting companies, just print shares and do whatever they want.
Right. Right. Yeah, definitely not a free-for-all. The SEC, they
Ah,
want to protect investors, right? That's their job. So they have this thing called the one-third cap rule, which basically means a company can only sell a maximum of one-third of their public float, within a 12-month period.
oh, okay. So that makes sense. It's like finding that balance between helping companies grow and making sure they don't just, flood the market with shares and kind of dilute what everybody else has.
Yeah, you get it.
Now, you said dilution. That's a word we hear all the time, with investing.
Hmm.
Can you just break it down for our listeners? What exactly does that mean, especially with this baby shelf rule?
Yeah, so imagine you own a piece of a pie.
Pie.
Right. And then the company issues more shares, so it's like they're slicing that pie into more and more pieces. Now, you still have your piece, but it's just a smaller percentage of the whole pie. Right. So that's what dilution is. And the baby shelf rule, with this one-third cap, it tries to like mitigate that risk.
So it's like the SEC is saying, hey, you can, have your snacks, but don't eat the whole pie.
Yeah. Exactly. Don't go crazy.
All right. So this rule, it didn't just kind of show up one day. Where did this baby shelf rule come from? What was the thinking behind it?
Yeah, so back in 2005, the SEC, they did this big thing. They called it the Securities Offering Reform, and they were trying to, figure out ways to make it easier for all these emerging companies to get the money they need. And so the baby shelf rule was a big part of, what came out of that. They wanted to streamline the process, make it cheaper, make it faster, and ultimately give these smaller companies a better chance, at competing and growing.
So it sounds like they were trying to level the playing field a bit, recognizing that, it's tough for those smaller companies to get access to that money they need. But like you said, it's not just about making it easier for companies, right? There's that whole investor protection side of things. Were investors, when this came out, were they a little bit wary of this new rule?
Oh, yeah, for sure. Whenever you change the rules of the game, there are always going to be people who are like, I don't know about this. And some investors were worried that this would lead to, just a flood of bad offerings, or that companies would just use this, to take advantage and dilute shareholders without a good reason.
Right.
So that's why the SEC, they put in those safeguards like the one-third cap and the eligibility requirements just to kind of try to, you know, address those concerns.
Right. So trying to walk that tightrope, make it a little bit easier, but not too easy.
Exactly.
So let's talk about who can actually use this thing. What are those requirements to, qualify for the baby shelf rule?
So first of all, that public float has got to be below $75 million, like we talked about. And they also need to have been a publicly reporting company for at least, 1 year to show that they've been transparent. They can't be what's called a shell company, which is basically a company with no real business. It's just a shell.
So no sneaky stuff.
No sneaky stuff. They need to have a real business, and they have to be up to date with all those filings, with the SEC. No funny business.
Okay, so let's say a company checks all those boxes, right? They're using the baby shelf and they're doing great. They're growing, their stock is going up, and then suddenly, bam, they hit that $75 million public float, what happens then? Do they just lose their baby shelf privileges?
That's a good question. It's not like a hard stop. It's more like a graduation. Once they hit that $75 million mark, they just move on to using a regular Form S-3 for their offerings. It just gives them more flexibility with how they raise their capital, but it also comes with more scrutiny from regulators.
Oh, so it's like moving up to the big leagues.
Exactly, yeah. And that's actually a good thing. Graduating from the baby shelf is a good signal to the market, and it often means that bigger investors, those institutional investors, will start to look at them.
So it's a sign of maturity, right? All right, so let's flip it around. What if a company tries to bend the rules a little bit, tries to sell more shares than they're allowed to under the baby shelf? What happens then?
Well, the SEC, they are serious about compliance. And they have a lot of tools to, deal with companies that try to, not follow the rules. Sometimes they start with just a comment letter, which is basically just a warning.
Oh, like a slap on the wrist.
Yeah, kind of like, hey, we're watching you.
Don't get any ideas.
Yeah, exactly. But if the company just ignores those warnings or, keeps pushing it, then things can get a lot more serious.
Like what could happen?
Well, they could get hit with fines. The SEC could stop them from doing any more offerings.
Yeah.
And then there's the reputational damage, which can be even worse, right? Investors don't want to touch a company that's got problems with the SEC.
Yeah, like a black mark.
Exactly.
So there's a real incentive for companies to, be good.
Yeah, follow the rules.
So let's switch gears a little bit and talk about, what this means for us, for investors. We've talked about, the benefits for companies and the risks if they misuse it. But what about the ups and downs for investors?
That's the key question, right? It's all about understanding how this works and being able to spot those warning signs and those opportunities.
Okay, so let's start with the risks. We've talked about dilution, but what are some other things investors should be aware of when they're looking at companies using the baby shelf? What are those red flags?
One of the biggest ones is price impact. When a company says, hey, we're doing a new offering, even under the baby shelf, it can make the stock price drop.
Oh, really? Just the announcement?
Yeah, because basically it means there are more shares out there, and if the demand doesn't go up, then the price will go down.
Right. Simple supply and demand.
Exactly. And this is especially important for smaller companies because they tend to have less trading volume, compared to the big guys. So that means that any news, like, a new share offering, can make the price move a lot more, make it more volatile.
Volatile, that's another word that makes people nervous. So it sounds like that's something investors really need to think about with these companies using the baby shelf.
Yeah, for sure. You need to be okay with the fact that the price might go up and down more. It's not for the faint of heart. But on the other hand, that volatility can also be a good thing if you know what to look for. It can be an opportunity.
So volatility is a big one. What else should investors be watching out for?
Another big one is, management transparency, or a lack of it. You want companies that are clear about how they're going to use that money they raise. If they're just saying like general corporate purposes, or they're not updating you on how that money is being spent, that's a red flag. It's like they're saying, just trust us, we'll figure it out.
Right. Yeah, that doesn't sound good.
No. You want to see that they're using the money wisely, that they have a plan, that they're actually making progress.
So you want them to be good communicators.
Yeah, exactly. You want to see that they're not just raising money all the time without a good reason.
So are there any specific things in, company filings or announcements that kind of scream, warning, warning, stay away?
Yeah, definitely. One thing to watch out for is how often they're doing these offerings. If they're constantly using the baby shelf, raising a bit here, a bit there, it could mean that they're having trouble making money or managing their cash flow, like they're just trying to stay afloat.
So not just how much they're raising, but how often they're going back for more.
Yeah, exactly. Good point. And another thing is how they describe how they're going to use the money. Are they raising money for, research and development for a cool new product? Are they buying another company? Or are they just using the money to pay their bills and keep the lights on?
So is the money going to help them grow, or is it just going to keep them alive for another week?
Yeah, that's a good way to think about it.
Like, are they building something or just trying to, not sink?
Yeah. You got to be a detective and do some digging to figure out what's really going on.
Okay, so what else?
Yeah.
Any other warning signs?
Yeah, another one is if they're always offering shares at a big discount, It might seem like a good deal, but it could mean that they're really desperate for cash and they'll sell those shares for less than they're worth just to get some money in the door.
So if it seems too good to be true,
It probably is. You got to ask yourself, why are they offering such a steep discount? Is it a good strategy, or are they just trying to hide something?
It's all about connecting those dots, right?
Hmm.
So let's say there's this biotech company. They're working on a new drug, some exciting early results, but they need a lot of money for clinical trials. So they decide to use the baby shelf to, raise money in smaller chunks over time. What should investors be thinking about in that situation?
That's a great example. And it really shows the kinds of things investors need to think about. The first thing is you got to understand the science behind the drug. Is this something that could really be a game changer, or is it just another Me Too drug? That's really important.
So going back to basics, what's the underlying business?
Exactly. Yeah. And investors need to do their homework right. Read those scientific papers, talk to experts, really understand the science.
So become an expert yourself.
Yeah, kinda. And then you got to look at the clinical trial design. Is it a good trial? Are they doing it the right way? Are they measuring the right things? Are they enrolling the right
But it's
patients?
not just about the drug itself, it's about how they're testing it.
Exactly. And then you got to look at the management team. Do these people have a good track record of developing drugs? Do they communicate well with investors? Do they have a plan for how they're going to use that money?
So we're evaluating the people in charge, making sure they know what they're doing.
Yeah, you got it. And then, of course, there's the financial stuff. How much money have they raised already? How much more do they need? How fast are they spending the money? What are their projections for future revenue?
So we're looking at their, financial runway. Can they make it to the finish line?
Exactly. So by looking at all those things, the science, the trials, the team, and the financials, investors can get a much better picture of whether or not this biotech company is, a good investment.
So it's a lot of work, but it's that homework that can really help you make better decisions.
Yeah, definitely. And I think the same approach, can be applied to other industries too, not just biotech.
Right, the details might be different, but the principles are the same.
Exactly. You always need to understand the business, the team, the financials, the risks. And you need to be okay with the fact that investing in smaller companies, especially those using the baby shelf, comes with its own challenges and opportunities.
It's all about being informed, being picky, and making smart bets.
Couldn't have said it better myself.
So we've talked about the risks, but let's not forget about the potential rewards. What are some of the good things about investing in companies that are using the baby shelf? What makes this such an interesting area for investors who are, willing to do their homework?
Yeah, that's where it gets exciting. Remember, these smaller companies, the ones using the baby shelf, they often have a lot of growth potential. They might be developing new technologies, shaking things up in their industries, or finding brand new markets. And if you can spot these companies early on before they get really big, the potential for returns can be huge.
So it's that classic high-risk, high-reward situation.
Exactly. But remember, it's not just about chasing those big returns. It's about understanding what's going on, finding those companies with strong fundamentals and good management, and being patient. Because it can be a bit of a roller coaster ride with these smaller companies.
It's about having a strategy, doing your research, and making those smart decisions based on, understanding the risks and the opportunities.
Well said. And that's where the baby shelf rule comes in. It's like this little window into how a company manages their money and what their plans are for growth.
Okay, so we've established that the baby shelf can be really useful for smaller companies, and it can create some good opportunities for investors who, do their research and are comfortable with a little bit of risk. But the baby shelf isn't the only way for companies to get that money, right?
Right. It's just one option. There are other ways companies can raise money, and each one has its own, pros and cons.
So let's take a step back. What are those other options, and how do they compare to the baby shelf?
Yeah, so that's a great question. And it's important for investors to understand all those options so they can, understand why a company chooses one way over another. So one option is a PIPE transaction, which stands for Private Investment in Public Equity.
PIPEs, those are always in the headlines.
They are. They've become really popular for companies to raise money quickly.
So break it down for us. What is a PIPE transaction?
So it's basically a private sale of shares to a small group of investors. Usually these are like hedge funds, mutual funds, or wealthy individuals. They agree to buy shares at a certain price, which is usually lower than the market price.
Oh, so it's like an exclusive club.
Yeah, you could say that.
Yeah.
And there's a reason why these investors like PIPEs. They get a discount, and sometimes they get other perks too.
Sounds like a good deal for everybody.
Yeah, it can be, but there are some downsides too. One is that, just like with the baby shelf, that lower price can dilute the value of existing shares. And sometimes PIPEs can make the market think the company is desperate for cash, especially if they're doing a lot of them.
So, like, they can't get money the regular way, so they have to go to these private investors.
Yeah, sometimes it can look like that. And PIPEs can be more complicated and expensive to set up than other kinds of offerings.
Okay, so there are definitely some trade-offs there. What about those ATM offerings? What are those all about?
So ATM offerings, they're called at-the-market offerings. And it's a way for companies to sell shares directly to the market gradually, kind of like dripping shares into the market instead of doing a big dump all at once.
So it's more subtle, less disruptive.
Exactly. And that's a big advantage. They can minimize the impact on the price and keep things more stable, especially for bigger companies with a lot of trading volume. And it's also more flexible because the company can control how fast they sell those shares.
So it's like having a little faucet they can turn on and off.
Yeah, that's a great way to put it. But of course, there are downsides too. ATMs can be slower and more expensive because of all the fees involved. And it might not be a good option if a company needs to raise a lot of money quickly.
So it's good for gradual fundraising, but not for emergencies.
Right. And then there are the traditional follow-on offerings where a company offers a big chunk of shares all at once. Usually this is for those bigger, more established companies that need to raise a lot of money.
Hmm.
And then there's debt financing where a company just borrows money.
Debt financing,
Uh.
a whole other topic.
Yeah, we'll save that for another day. But the point is, there are all these different ways for companies to raise money, and each one has its own pluses and minuses.
And it's up to us as investors to understand, why they're choosing one over the other.
Exactly. What does it tell us about their finances, their growth plans, how the market sees them? These are all really important things to think about when you're evaluating an investment.
It's like being a financial detective.
Yeah, you got to put those pieces together. And the baby shelf rule, it's just one piece of that puzzle, but it can tell you a lot about a company's, inner workings.
It shows how they think about their finances
Yeah.
and how committed they are to, taking care of their investors.
Well said.
So now we've got a good grasp of the baby shelf rule, where it came from, how it works, and, what other options companies have. Let's move on to some real-world examples. We've got some really interesting case studies to look at, to see how companies are actually using the baby shelf, both the good and the bad.
Sounds good. Let's do it. All right. So those case studies, should we jump into those?
Yeah, let's do it. I always find that looking at, real companies helps make this stuff make more sense. So first up, we have a company in the renewable energy space.
Yeah, this company, they had a public float of around $60 million. So, definitely in baby shelf territory.
So they used it right. What were they trying to do?
They did. They actually launched 2 offerings within about 10 months of each other, and they raised about $15 million each time.
Wow, that's a lot of money. What were they using it for?
Well, they were building a new factory to make more solar panels.
Oh, wow. That's ambitious. They were trying to, ride that clean energy wave.
Exactly. And you know what? Investors were into it. The stock price did dip a little bit after each announcement, about 3% each time.
Also, it did go down.
Yeah, but then it bounced back pretty quickly. In fact, within a couple of months, it was even higher than it was before the offerings.
So a little blip and then up and away.
Yeah. Investors saw the long-term potential, and they weren't too worried about the dilution.
They understood that sometimes you got to spend money to make money.
Exactly. You dilute a little to grow a lot. And in this case, the company did what they said they were going to do. They finished the factory on time. They started making more solar panels, and they got some big contracts. A year later, their public float was over $85 million, so they graduated from the baby shelf.
A real success story. They used the baby shelf strategically to grow their business.
Yeah.
And everyone benefited.
Yeah, it's a great example of how it can work really well.
But I'm guessing not all of our case studies are going to be this happy, right?
Unfortunately not. Our next company, a software company, they didn't do quite as well.
Ooh, okay, tell me more.
So this company had a public float of about $45 million. They were making a mobile game, and they needed money for marketing and to get more users,
So a classic tech startup, spend money to grow fast.
Exactly. And they decided to use the baby shelf, and they ended up doing 4 offerings in just 1 year.
4 offerings in a year. That seems like a lot. Were investors getting nervous?
Oh, yeah. Remember that 1/3 cap we talked about? They
Yeah.
were basically using it all up.
Maxing out their credit card. That would definitely make people nervous.
It did. And on top of that, they weren't very clear about how they were spending the money. And it wasn't clear if their game was actually doing well. So investors started to get really worried.
So not transparent, lots of offerings and questions about how they were spending the money. Not a good look.
Not at all. And the market reacted. Their stock price just kept going down, and they never even got close to that $75 million mark to graduate from the baby shelf.
Sounds like they were using the baby shelf to, cover up some bigger problems.
Yeah, kind of like a Band-Aid on a broken leg. They were just trying to survive, not really grow.
Okay, so one success, one not so much. What's our last case study?
This one's about a healthcare company. They had a public float of about $70 million. They were close to graduating from the baby shelf, but they needed a little extra push.
Okay, how'd they do it?
They decided to do one more offering under the baby shelf for $10 million. And they were really specific about what they were going to use the money for to buy a smaller competitor.
Ooh, interesting. So a strategic acquisition using the baby shelf.
Yeah. And the market loved it. They saw it as a smart move.
Did the stock price go down at all because of the dilution?
A little bit, yeah, about 2%. But it didn't last long.
So investors focused on the long-term benefits of the acquisition.
Exactly. And within a few months, their stock price was up over 20%, and their public float went over $80 million.
They made it, graduated, and ready for more growth.
Yeah, a perfect example of how to use the baby shelf effectively to achieve a specific goal.
So these case studies really show that the baby shelf can be good or bad, depending on how it's used.
For sure. It all comes down to, the company's intentions, how they execute their plan, and how well they communicate with investors.
So we've looked at the rule, the alternatives, and some real-world examples. But we haven't talked about the SEC yet.
Oh, yeah, the SEC. What are they up to with all this?
Exactly. Are they just watching from the sidelines, or are they more actively involved in, shaping how the baby shelf is used?
Oh, they're definitely not just watching. They're keeping a close eye on how companies are using the baby shelf, looking for any signs of, people trying to cheat the system. They want to protect investors and make sure the markets are fair.
So they're the referees, making sure everyone plays by the rules.
Exactly. And they're not afraid to call foul. One way they do that is by sending these things called comment letters.
Comment letters, those sound scary. What are they?
Think of it like a little tap on the shoulder from the SEC, like, hey, we've got some questions about your baby shelf offering. Can you explain? It could be something small, or it could be something more serious.
So it's a warning.
Yeah, like a we're watching you kind of thing.
Don't try anything funny.
Exactly. And companies take them seriously. They know that if they ignore them or don't answer the questions properly, things could get a lot worse.
So better to cooperate and be transparent.
Oh, yeah, for sure. The SEC wants companies to use the baby shelf the right way. They want them to be clear about what they're doing, how they're using the money, and that they're really trying to benefit their shareholders.
So the SEC is walking that tightrope too, right? Helping companies grow, but also protecting investors.
Yeah, exactly. It's a tough job.
So what can investors do, to protect themselves and make good decisions about companies using the baby shelf?
Well, first of all, don't be afraid to dig in and read those SEC filings. I know they can be a little boring, but they have a lot of good information.
So go straight to the source. Don't just rely on headlines.
Right. Pay close attention to those S3 filings. That's where they talk about the baby shelf offering, look at how much they're raising, how often they're doing it, and what they say they're going to do with the money.
Okay, that's a good starting point. What else?
Look at the company's history. Have they used the baby shelf responsibly before? Have they done what they said they were going to do? Have they been honest with investors?
So we're looking for patterns, trying to see if they're trustworthy.
Exactly. And don't be afraid to ask questions. Call up investor relations, go to their earnings calls, listen to what the management is saying.
So be an active investor, not just a passive one.
Yes. And remember, diversification is key. Don't put all your eggs in one basket. Spread your risk across different companies and different industries.
Always good advice.
Right. Investing in these smaller companies, especially those using the baby shelf, can be a good thing, but it does have risks. So do your homework, be careful, and manage your risk.
So be informed, be strategic, and be patient.
Well said. And remember, the baby shelf is just one part of the whole picture. There's so much to learn about investing, and the more you know, the better decisions you can make.
Okay, so we've covered a lot today, but before we wrap up, I want to go back to something you mentioned earlier about investor psychology.
You mean how people feel about these baby shelf offerings?
Yeah, we talked about, the price impact and the volatility, but I'm curious about the emotional side of it. How do people usually feel when a company they own announces a baby shelf offering? Are they scared? Excited? Confused?
It's a mix of everything, really. Some people see it as a bad sign, like the company is desperate or that their shares are going to be worth less. Others see it as a chance to buy more at a lower price, betting on the future. And some people might not even notice or care, especially if it's a small offering or they're in it for the long haul.
So it depends on the person, how much risk they like, and their overall investment strategy.
Exactly. And that's why it's important to know yourself. How do you react to news? Do you freak out when the price goes down a little bit, or can you stay calm and look at the bigger picture?
So self-awareness is key. Understand how your emotions might affect your decisions, especially with things like baby shelf offerings.
Couldn't agree more. And sometimes those baby shelf offerings can actually create a self-fulfilling prophecy.
Oh, really? How does that work?
So imagine a company announces a baby shelf offering, and a few people get scared and sell their shares, right? That pushes the price down. And that lower price might attract some bargain hunters, but it might also scare off other investors who think something's wrong. And if enough people sell, the price just keeps dropping and dropping.
Oh, wow. So it's like a snowball effect.
Yeah. How people feel can really affect how the market reacts to these things. So it's important to, not get caught up in the panic, do your own research, and make your own decisions.
So don't follow the crowd. Think for
Yeah,
yourself.
exactly. The baby shelf rule is just one tool. It's not the whole story. It's how companies use it and how we understand it that really matters.
This has been a great conversation. We've learned a lot about the baby shelf rule, the good, the bad, and the psychological. But I want to leave our listeners with one final question to think about. So we've talked about, how the baby shelf works, the good and the bad, and even how people feel about it. But here's the big question. How can you tell if a company's using the baby shelf, strategically to grow, or if they're just using it as a crutch to, stay alive?
Ooh, that is the big question. And it's tough. There's no easy answer. But, there are some clues, some things you can look for.
Okay, so what are some of those signs that a company is using the baby shelf the right way as a tool to, really grow and innovate?
Well, one of the most important things is to look back. What's their track record? Have they used the baby shelf before? Were they able to raise money without, hurting their existing shareholders too much? Did they actually use that money to do what they said they were going to do?
So it's like checking their references, right?
Yeah.
Seeing how they've handled this before.
Yeah, kind of like that. The past isn't always a perfect guide to the future, but it can tell you a lot about how a company is run and whether they care about their investors.
Makes sense. And what about their current offering? What are some good signs there? That they're being strategic and not just desperate.
One big thing is how clear they are about what they're going to do with the money. Are they raising money for a specific project or to buy another company, something that's part of their, bigger plan? Or are they just saying vague things like general corporate purposes or working capital, which could mean they're just trying to, keep the lights on?
So the more specific they are, the better.
Exactly. It shows they have a plan, they know what they're doing, and it shows they're being transparent with their investors.
Transparency, that's a key word, right?
Oh, yeah, for sure. Transparency builds trust, and trust is really important when it comes to investing.
Right, you got to trust the people you're investing in. And speaking of trust, how about communication? How does the company communicate with their investors? Are they open to questions? Do they give regular updates?
That's another big one. A company that's using the baby shelf strategically, they're usually really good at communicating. They know that investors want to be kept in the loop, and they're willing to answer those tough questions.
So they're not hiding anything.
Yeah. And they're not just communicating when they need money. They're giving updates all the time about, how the business is doing, their financials, their progress towards their goals.
So it's like a real partnership, not just a one-way street.
Exactly. And I think the last thing I'd say is that companies that use the baby shelf well, they usually have a really clear vision for the future. They're not just trying to survive. They're trying to, change the world.
They're ambitious. They're dreamers.
Yeah. They're the innovators, the disruptors. And those are the companies that investors should be really excited about.
It's not just about the numbers. It's about the passion, the energy, the drive.
Yeah. It's about finding those companies that are using the baby shelf to, unleash their full potential and create something amazing.
Well said. This has been a fantastic discussion. We've learned so much about the baby shelf rule, how it works, the risks, the rewards, and even how it can affect us emotionally as investors. I hope our listeners are feeling a lot more confident about, evaluating companies that are using this tool.
I hope so too. And keep learning, keep asking questions, keep digging. The world of investing is always changing, and the more you know, the better you'll be at making those smart decisions.
So true. Knowledge is power, especially when it comes to money.
Yeah.
And do your own research. Talk to your financial advisor. Make sure you're making the best decisions for you.
Absolutely. And remember, investing is a marathon, not a sprint. It's about learning and growing along the way.
Love that. Well, on that note, we'll wrap things up for today. Thanks for joining us on the deep dive.
It's been a pleasure. Thanks for having me.
It's